Hello, and welcome to the State Street Digital podcast. I'm James Redgrave, Vice President of Thought Leadership and Editorial for State Street Digital. And I'm joined today by Sven Werner, Head of Digital Custody for State Street Digital, and Justin McCormack, Head of State Street Digital Legal. Thank you for joining me.
Great pleasure to be here.
Yeah, thanks very much.
So, you both contributed articles to our latest Digital Digest and both touched on themes of regulation, in particular, how regulation can be created or amended to facilitate more digital tokenization infrastructure for traditional assets and how the regulation environment needs to sort of catch up for that to happen. So interested in both of your thoughts on that. Sven, would you like to kick us off?
Yeah, sure. I mean, this is a very topical issue that has been around for quite some time. And in a way, you always wonder, can you define the end goal? How exactly should this all work? And in the absence of that, obviously, there's a risk in terms of just asking for regulatory help without really being clear on the details. Sometimes may also lead to undesirable outcomes. For me, there's a side effect in terms of, how do you move or migrate from a legal environment today that assumes there to be a centralized market infrastructure, a CSD, and replace it with something more loose in terms of a decentralized market infrastructure. Obviously, that's one aspect. But in order to really reap the benefit, I think there's some additional points that recently became quite apparent. So, for instance, how do you comply with KYC obligations if you really truly want to create a peer-to-peer market infrastructure? So the current solution, if you look, for instance, at crypto, would be that on the one hand side, you have peer-to-peer blockchain networks, and then you have the KYC ML information flowing outside of that. And that in itself creates new reconciliation needs that are not really efficient. And so we need to find a way to bring regulation, KYC, ML, these kind of requirements into a blockchain solution. For me, this is a very important aspect to the future state of regulation.
Thanks very much. Justin, bringing you in here, I guess more from the regulators and the lawmakers' perspective, what needs to change in terms of their approach to this or their way of thinking about it for the types of change that Sven's just talking about to become implemented at the sort of legislation and regulation level?
Yeah, and that's a great question. And a big part of it is understanding what exactly the regulators are trying to do. And I think one of the things they're going to look at is focusing on the number of the issues that we've had during this crypto winter. So FTX is the latest of them, but there have been others preceding it in terms of, for example, the Voyager and bankruptcies, the Terra Luna scenario. And I think we're going to start to see them drawing themes from those. Is to say, there are certain things that we need to try to create. We need to create separation of financial activity. So there's a lot of vertically integrated entities like FTX, like Voyager, where there were both trading and custody and maybe some lending activities going on as well in the case of Voyager. In the traditional world, those are handled by separate entities. In the digital world today, in the crypto world today, in many cases, it's been vertically integrated. And I think that's something that we're going to see kind of a shift from what regulators and lawmakers are going to push for. Clearly, segregation of client assets is going to be kind of core to what regulators will focus on, as well as how are entities maintaining control over the assets. So I think those are going to be three themes that the regulators will focus on. Each jurisdiction is kind of taking their own approach to that, while there is kind of coordination being encouraged by international bodies, such as the Financial Standards Board. And I think we're going to see more regulators following those themes and trying to introduce legislation and regulation that will address those. And I think partly what that means is that we're going to end up with something that a system that doesn't see the complete elimination of intermediaries. I think we're going to see a reduction in intermediaries, but I think intermediaries will still play a part in a fully regulated environment, simply because that's the way that the regulators really know how to implement their regulations. Is they regulate the intermediaries to regulate the market. And so we need to improve things about certain regulators, the way regulation is done. But I don't think we're going to be eliminating it fully in the proposals that we'll see come out this year.
Sven, does that tally with your view on the way the market's developing?
Yeah, I think Justin hits on a very important point. This obviously, in a sense, a true blockchain network, which has a lot of what we traditionally would call, process workflows, these kind of things being coded in the software. And so all you really need is, when you look at crypto right now, you need the account number of your counterparty, and you need to know how much you're going to send, and a few data fields enough allow the system to really perform the exchange and do all of the normal activities. But this comes at a price that certain information that are relevant to, if you want to give these bookings financial meaning in terms of who is the owner, what was the price paid, what was the time, it's all of these kind of things have to be associated with data that doesn't necessarily originate in the blockchain, and somebody has to do this. And so what the crypto network today does is they rely on some forms of, if you want, the data oracles. That's also required, for instance, for smart contracts, that these kind of business reference data points have to come into the blockchain environment. And this creates a question of trust, where you create a blockchain system with the idea to have a trustless network, so without regulated intermediaries. But then the blockchain can only fulfill its purpose if it has trusted data. Now, we may not call this the traditional intermediary, but it looks very similar to that. So these functions come back just in a slightly different way. And I would very much agree with Justin, say that regulators are very likely to pick up on those points and have a way of regulating that market.
That's interesting. And the question of trust as well sort of relates, I think, Justin, to what you mentioned before to do with FTX, which is that we have a lot of sort of new entities in the market, and there is a question, I think, about the extent to which the regulators understand them and the extent to which, because they are not regulated in the same way, the services and the information that they provide can be trusted. To what extent is that an opportunity for more sort of traditional mainstream financial service intermediaries and service providers to step into this space if they get the technological expertise and the technological systems in place?
Yeah, I think it's a great opportunity for the traditional providers to really gain a foothold in the market. And I think one of the things that we've seen to date in the crypto environment is that the leading players are very, very strong on technology and very strong on innovation and how technology can be used to innovate. But what they've been lacking is the risk management structure, the oversight controls, and the control environment that is developed over numerous years in the traditional financial institution and really plays a key part in protecting investors. And so I think you're going to see this kind of merge of the two kind of subject matter expertise come in. And in the traditional finance space, what many of the players are really building up the technology subject matter expertise that they have. Traditional finance firms are becoming more and more focused on technology. And with that, and with their strong focus on risk management and control, they're really going to be set up to work well in what I think will be the new regulatory system that comes out of this, which will, I think, take a lot of the regulatory controls, the risk management and the control environment from the traditional space and try to incorporate that, as is appropriate for crypto technology. So I mentioned before kind of three core areas: separation of financial activities, segregation of client assets, proper controls. Those are things that traditional financial institutions today are required to do. And so they have that infrastructure and they can build up their technological base and will be in a great position to kind of thrive in the new digital marketplace, which I think is going to be another tweak where the focus to date has largely been on cryptocurrencies. And while I think those are going to stay around for quite a while, I think we're also going to start to see a shift into focusing on digital assets in a much broader sense. And I think that's also another area where traditional finance will have an edge, I guess, in terms of familiarity with traditional securities that may be in tokenized form. And that, I think, is really the future of digital assets as an asset class.
And Sven, from a technology, process, market infrastructure perspective, how easy is it to incorporate sort of existing forms of regulation or regulations, existing intentions into this new environment? Or to what extent is it a sort of square peg, round hole situation?
I think that the important point, obviously, is to distinguish here between cryptocurrencies and, if you want, a tokenized financial instrument that happens to use a form of a decentralized network. So in a certain way, it's very hard actually to think of a cryptocurrency as any other digital assets. There are numerous aspects missing. One instance, for instance, being the lack of an issuer. So by holding a cryptocurrency, per se, you're not holding any rights in the same way you would be a shareholder or bondholder today. And with this comes to more consequences around the, if you want, questions of control. Yes, you have a private key. With that private key, you can sign a cryptographic transaction, and with that validate something. But the network, it's again a peer-to-peer network. If it works correctly and the consensus mechanism is adhered to, it will respect that and then process it correctly, but it doesn't have to. You can be, if you want, overruled. You can also issue securities or like a cryptocurrency, so with smart contract functionalities that allows also the issuer to invalidate certain transactions. And these are risk aspects that are completely absent to a traditional financial markets. So integrating this in a traditional setup is quite challenging. Now, on the flip side, if you were then to look at a security token, these other things, that's obviously much easier if, and that's very important, if we can find a way to bring the regulatory and oversight requirements into an actual blockchain functionality, because otherwise you run two systems in parallel, where you on one side have the automated instant atomic settlement of a blockchain, whilst the regulatory requirements reporting reconciliation will happen through off-chain processes, and that ultimately is not very efficient. But I think we have a good chance with the support of regulators to really think how the transparency that a blockchain system can deliver, how this can also change over time the way we have to comply with regulation. So it doesn't take away the regulation per se, it may change the way how we comply with it.
That's interesting. Thank you. Justin, talking a little bit now about the sort of timescales involved with this, given your expertise in how regulation is formed and how regulators and legislators operate, how close do you think we are to the kind of meaningful change in regulation that would allow the sort of mainstream financial integration that we're talking about here?
The regulatory process it's typically not a very swift process. It is somewhat time consuming, and largely because it is people take time to come up with meaningful and thoughtful regulations. But I think what we've seen is the occurrence of an event like FTX has really galvanized regulators across the globe to do something more quickly. So there's been a lot of talk over the past couple of years, and there's been action in many jurisdictions. And for example, in Europe, the MiCA regulation, the markets and crypto asset regulation, has now been finalized. It's looking to be signed in the first quarter of this year and will be scheduled to be implemented by 2024. But we're also seeing, U.S. regulators coming out. There's been a couple of law or bills, or many bills introduced kind of further along, the Responsible Financial Innovation Act and the Digital Commodities Consumer Protection Act. They were actually both filed just prior to the FTX bankruptcy, but I think there's been a lot more focus on those. We'll see in Australia, they've come out in the wake of FTX and said that they intend to introduce regulation this year. Similarly, in Korea, they've also indicated in the wake of FTX that they're going to be coming out with regulation this year as well. And so I think we're going to start to see a number of proposals come out this year. And I think we'll have some that's actually, some things that get finalized this year. But I think 2023 will be the year that we really focus on kind of concrete proposals, moving from the kind of the thought process about what we should be doing to, okay, this is what we're going to do. And then 2024 will be the year of implementation.
Thank you very much. And Sven, thinking about this issue of regulation and also perhaps more generally technology and market infrastructure, how close do you think we are to seeing mainstreamification, for want of a better word, of this type of digital asset?
Yeah, I think that depends a little bit in terms of creating a core licensing framework in some shape or form for providers of quote-unquote crypto custody. I think that is something that across the globe is a common shared objective, and also recently by the FSB consultation been re-emphasized that regulators need to have the ability in the first place to have the mandate and authority to regulate this activity. But from an institutional perspective, it may not necessarily be enough. So an asset manager who's managing third-party assets and therefore appoints a custodian that then helps to protect those investments, the current regulatory framework goes further in terms of saying you will have specific asset management regulation, how that custody is being provided. So unfortunately, in many ways today, the debate is around the technical aspects like a particular key management solution. And whilst it's interesting, this in itself is not yet sufficient to make it custody for a regulated asset manager. So if you want the consistency between asset management regulation and crypto custody, so to speak, is something I would say that's still a long way to go. And it creates certain conflicts in terms of, for instance, control aspects that today are expected from a custodian of traditional securities, whether there could be something equivalent for crypto assets. I think that for myself is something that the regulatory, if you want, depth of the activities here concerned and the end-to-end consequences is something that still has to be looked at. On the flip side, I would say also there are some real learnings that we can bring from FTX and other market events back into the tokenized securities market, which is, for instance, around the question like where does the efficiency from a blockchain comes from? Well, it comes from many things, but for me personally, two important aspects. One being the composability of smart contracts, and the other one is that you have a way of resolving the trust data issue that I mentioned earlier. And that is something that we've seen in recent events being a particular risk factor, that if you hold a token and that token promises you something in terms of saying, I give you the title to certain assets, and this not being true, then the efficiency of the blockchain collapses. And so therefore, when we then design security tokens, they will also have to comply or adhere to a certain quality standards in terms of the means by which it can verify that the, if you want, the ownership rights that this token signifies, whether they're actually there and how they're enforced and who's behind that. And that's only with that discipline, I think we can overcome the current shortcomings of the market.
That's excellent. Thank you very much. And thank you very much for joining me, guys. Before I sign off, any final thoughts or anything that we haven't touched on today that you think is relevant to this conversation?
This is really a kind of, I think, a turning point in the crypto and the digital asset space. I think, there's been a big increase in 2021 in the crypto asset marketplace. The valuations grew exponentially. We've had obviously a decline in 2022, ending with the end of the year with FTX. And while some may say that this is the end of the crypto marketplace, I don't think that's the case at all. I think this really is the beginning of a more structured and regulated environment where the digital technology and tokenization and blockchain will really come into focus for regulators, and that we'll see regulation that allows clarity for the growth of digital assets more broadly going forward.
Great. Well, thanks again, Sven and Justin, for joining me.
Thanks very much.
Thank you.
To learn more about the topics discussed in this podcast, or to read the full January State Street Digital Digest, or see the full results of the State Street Digital Assets Survey, visit statestreet.com.